Hey everyone, welcome back to the channel. Today I want to go over an important question. Is there an optimal number of investments for your portfolio? So I want to thank Skeptic727 for this thought-provoking question. Um, I've I've grappled with this question myself for quite a while. I've been trading and investing for some time now, and I've always wondered, is there like a perfect number of a number of investments for your portfolio? And unfortunately, nope. There's no like magic number. I wish I could say it's like 15 or 20 or something like that. But there is an optimal range for you, so let's get into it. So back when dinosaurs were roaming the earth, I was a poor college student. There's no shame in being poor, but there is shame in staying poor. So, after working a few part-time jobs, paying for tuition and textbooks and things like that for college. I was also scrimping and saving for my first Vanguard mutual fund, and that's how it started. I remember like it was like $3,000, and like to me that was like a lot of money at the time. And thinking back, it was like, man, I did a lot of crazy things just to like save up that initial amount. But if I didn't get started, like I wouldn't be here. Where at this level. The important thing is to start and give yourself enough time and just like whenever you can, after you pay off your expenses, just chip away and throw like $10 here, $50 there, $100 there, and it really saves adds up over time. Assuming you're in like the right investments, of course, and it does involve a little bit of luck, but the most important part is I would say is time. And then also you have to factor in like how many funds do you really need? And at the time there wasn't like YouTube or Twitter or Reddit and like those resources weren't around. So I had to figure a lot of things out by reading just a lot of books and a lot of newsletters. And of course like the most important part was like the finance textbooks because I paid a lot for those textbooks and at the time those were like kind of like the only like source of like really good information, and thankfully like now there's a lot more info out there, and it's mostly free. So like for the textbook answer at the time, uh the optimal number of investments was between 8 and 32, and between like 8 and 32, when I say investments, I mean like different types of investments. So like for example, like we're talking like stocks, bonds, commodities, watches, gold. Some of the more like traditional investments that like rich people like to have, that also includes artwork, maybe like patents and things like that. And then like between 8 and 32, that'll give you like 95% of the benefits of like the so-called like perfect like diversified portfolio. And if you want to like think about it, anything more than that, like you're starting to really uh, like some of the benefits of diversification start going away. Like for example, let's say you have like $10,000 to start. For someone at that level, it doesn't make sense to have so many investments because like you're not gonna get that much benefit from like let's say like you find like 100 like ETFs. And if you're only starting with $10,000, like you're only putting like $100 into each, and that's not really that helpful because there's going to be like some overlap, and you might be like double counting on like some investments, and that's not gonna really benefit you in any way. So generally, like the smaller the amount, like the less investments that you should have, and then also like kind of like the reverse. Um, you know, uh, Over time as you get more and more money, that's when you can start layering in into different types of investments. Because hopefully, um, you know, in a bad economy, like you'll have some investments that might benefit. Let's say, for example, you have like a really good YouTube channel, right? And you're bringing in like some money that's like a little bit more consistent, or maybe you have some type of like side business, and that's still valuable even in a bad economy. Let's say like I might be like a simple basic like food company, like a food truck or something, and like people still have to eat. So like chances are like those types of like small businesses, those are tend to maybe do better. Um, and then in the old days, you could get away with like actually just like three investments, because there wasn't so much opportunities like back then. Like you can get away with just like having a diversified stock fund, a bond fund, and cash. And if you have like trouble sleeping at night, you can, and you want to nerd out, you can go through like a search engine or just go look for something called the French frontier and portfolio diversification. I would say like generally ETFs offer safety in numbers, but it's only helpful to a certain point. But things have changed. Now, like there's actually, in my opinion, there's too much diversification. There's like so much stuff out there that it's really hard to keep track. You have like different styles. You have like value versus growth. Then you, then you have like different like global funds. Like you can actually for a lot of uh, countries, you can actually find the ETF for that. Like if you really dig deep enough. And then there's also like different sectors. So on the right hand side, you see like the S&P 500. It gives you kind of like the 11 like sector breakdowns. And so you can kind of like swap in and out like within each of these different sectors because there's like for example, if you want more energy exposure, you can put more money into like XLE. And then like if you want more financials, you can have XLF and et cetera, et cetera. But keep in mind, like everybody's, even if you have like $1 billion, you're still limited to like the amount of money and time that you have. Um, and for I think for most people, like time is kind of like the most important limiting factor. I think sometimes like good enough is sufficient. And then you also have to take into account like the new stuff that's coming out, like the crypto and volatility ETFs, like even farmland. I think for most people, the important part is to just start, and then you can kind of like swap in and out as you see like new opportunities, and you don't have to be locked into like any uh, like a set number of investments. So, like for example, like your life is going to change. Like when I was a young guy, like I was really aggressive. I really liked like small caps. But then like as I entering middle age and I'm starting to prepare for like when I'm like at retirement age, I'm trying to be a little bit more conservative, and I'm also want to spend less time just like micromanaging and micro trading like my accounts because like it's really stressful and you have to take that into account too as you get older. And then also like maybe like you want to start a family and that's gonna take up more time too. That's actually more important. So again, there's no like perfect number. And you have to kind of take into account your personality and your own like time and then also your own morality. For example, I'm not a fan of like cigarettes and like war type of stocks. Like for example, like Lockheed Martin. But that's just me. Like if you don't mind, obviously you can invest in whatever you want. But at some point, like even for myself, like if I see like the cigarette companies or like a like a defense contractor, if it gets to like a cheap enough price, like I might be tempted. So you have to take those into account. But there's hope. Um, like over time, like life will change, but then also there'll be like new ETFs that come up that might account for like these changes in your life. For example, like there used to be uh these special ETFs. Basically, what they do is like um as you get older, they'll change like the percentage that you have in stocks, and they'll put it more into like more fixed income. So I think like over time we'll see like especially as AI gets better, you might be able to set up like portfolios that kind of like self-optimizes itself based on like your risk preferences and things like that. And there's so many like new ETF companies that's coming up with just amazing returns that like I've never seen them before. Like yield max and defiance. I mean, my goodness, these are just amazing. So there's going to be like new type of funds and new type of investments. Like we have zero DTE already, and then we also have like Bitcoin and Ethereum ETFs coming soon. So, and I would say it's about time. So for myself, here's how I would like to think about it. Don't lock yourself into like a specific number. I would say like think about like a range, and you can kind of adjust from there. So for example, I like to have like a maximum of 10 core positions, and then I also like to have like up to 15 temporary positions because I think for myself, 25 is like it's already like a pretty sizable amount of positions that I can really comfortable keep track of. Um, and I would say like even this like it's subject to change. Like for example, like TSLY, that wasn't on my radar originally, but then like it was at such a cheap price, and then also the yield. I thought to myself that it's too good to pass up. So eventually, this might go from like a temporary bucket to like my core bucket. And then I also have to take into account like my age. As I get older, I'm gonna want more dependable types of income. So like I'm gonna probably shift this from like 10 core positions to maybe 15 and maybe even 20, and then like leave like the kind of like the more speculative stuff. Because those are the ones that take a lot of the time for myself. And I'm probably not gonna like I'm just not gonna have the energy anymore to like really like babysit my speculations. So, but of course, like I think like a lot of like the general audience is probably on the younger side, so you can feel free to like bump this up from like the temporary speculative positions like all the way up to like 20 or even more than that, like depending on your time. And of course, like within like your ETFs, you have to take into account like any overlap. So, like for example, since like the cover call funds are pretty popular, you have to be careful not to already overdo some of the short volatility. Because remember, like when you're short, when you're in a cover call fund, basically what you're doing is like you have like some short calls in there, which is short volatility. So, for example, it doesn't make sense to pair JP JEPY with SVOL because they're both short volatility. So like it doesn't make sense. You you're probably better off if you want to hedge. You want to pair off JEPY with something that has like a long volatility component to it. And then I would say like SVOL is it's not a bad fund. It's just like how you want to like position yourself. So like for example, SVOL since it's short volatility, it might be okay for like a regular dividend ETF. For example, SCHD is a pretty popular dividend portfolio, but it doesn't have any like options involved, and so it doesn't have any short volatility. So that's where like SVOL and SCHD might make like a better combo. And then just to show you um, like why you have to be careful not to over diversify. If you look at just like the regular triple QY ETF and the SPY ETF, you can see like if you look at it, like the holdings are pretty similar. So it's just like the percentage of assets that's a little bit different. So like almost 50% is concentrated in like the top 10 names for triple QY, and then for SPY it's a little bit more spread out. But if you look at the just the top 10 holdings, like they both have Apple, they both have Microsoft, they both have Amazon, and both have Nvidia, and then et cetera, et cetera. So it doesn't make sense to hold both. I would say it's probably better to kind of pick like if you like tech, then you're better off with triple Q, and then if you like something more diversified, you're probably better off sticking with SPY, and then going from there. And then like if you're ever having trouble with keeping your like the amount of like investments that you have in check, like for example, a common problem is like, well, like should I take profits and when should I take profits? So one thing that you want to think about is maybe doing position sizing. This way you don't have like any one investment get too big. For example, like back in 2021, a lot of people were actually overexposed to something like Tesla because like I mean it grew like and it kept growing and growing and it was just like like for some people it's like up to like like something ridiculous like 90% of the portfolio. So in order to practice position sizing, you want to look at it like maybe like your overall portfolio, like maybe like once a quarter, and start thinking, well, maybe I should sell some of this Tesla and then like um, raise cash, and then this way you can start thinking about like other investments that you want to make. Because when you have something so big, you don't want to like lose the profits. Like you want to like maybe take some profits here and there, and then kind of like rebalance your portfolio. And then the second tool that's helpful for like pruning your portfolio is to use trailing stops. Now I know it's not perfect, but it's a pretty useful tool. Like you can use it as a you can use percentage trailing stops or you can use a dollar trailing stops. So as like your investments go up, like the trailing stop will follow like the stock price up, and then at some point like the maybe there's like a recession or something, and then like your trailing stops will help you, will force you to take profits. And then also like the kind of like the not so fun side is that if maybe like the stock isn't performing um, as you expect, this will also force you to cut your losses. And then also keep in mind like never fall in love with any one investment because you just never know when things start to like fall apart. And I would say like generally speaking, less is more. I think everybody's time is precious. You want to get rid of like these scumbag stocks and deadbeat ETFs that are hogging up space in your portfolio. Because it's not just what your portfolio, it's also your mental space. Like for example, like right now, I'm kind of suffering through with CVS and 3M. Those are two companies like they haven't been performing well, and it's just kind of like mentally aggravating. So you don't want that. Like you want to just get rid of them and so you can focus on like other things. And then I would also say that like, at some point there will probably be like another like global crisis, unfortunately. And and when and when there's a lot of stress, it's gonna be hard to like find time to analyze. So the less things that you have in your portfolio, the easier it is to like to assess the situation and get rid of non-performing assets. So you want to think about like your portfolio like a sports team. There's gonna be times when you want to just like stick it on a watch list somewhere and like come back to it later, or like if they're so bad, you just gotta get rid of them. So like people like sometimes like if a stock underperforms, like for example like CVS, um, you don't have to get rid of it totally. You could probably like maybe sell half or something like that. But then you also want to keep it on your watch list just in case, like maybe there's a chance to come back. And if it starts performing well, then you can start uh, layering back into your portfolio. And then like this way, you have like kind of like a like something to swap back into when things get better. So I know this sucks, but it's gonna take some time and some effort like upfront to kind of set up the portfolio that you want. Um, but I think it's gonna be worth it, especially like when you get older and or like when you're going through like a life event, like maybe a marriage or like a divorce or death and family and stuff like that. But like over time, you're gonna pick up speed, and then like this will be like value experience, as you grow as a trader or an investor. So I would say like um, in general, like there's so many tools out there, and they're mostly free. So portfolio management is a lot easier now. In personal finance in general, I would say it's like the costs are lower than when I first started. And there's so many like cheap and free resources. And then maybe I'll update like a video um, that I heard earlier on like free resources that you can like research like your favorite like stocks and ETF. I would say like generally speaking, there's a lot more transparency nowadays. So I think like things are looking good, especially if you're a younger trader and investor. Uh, Things are so much better now than like when I started. So of course, like some of the risks that are still out there that sometimes like these expense ratios, they're still a little bit high for my liking, and I hope that like as the fund grows, especially like something with yield max, like the ratios will head back down. And then you always have like the problem of like there's so much stuff out there now, like you kind of have to force yourself to focus a little bit more, because otherwise you're gonna wind up with like analysis paralysis and you know, when you're investing, time is probably like the most important factor. Because like for money, you can always like get like part-time jobs or whatever, and like just add. The most important part is just like start and like develop like good habits later down the road. So hopefully this wasn't too like dense. I know it's not like the most fun topic, but I think it's really important. So if you like this type of content, please consider liking and subscribing. Otherwise, I'm gonna have to go on like OnlyPans and start selling like feet pics and crap like that. I would say like generally, my subscribers are healthier, wealthier, better looking, and more well endowed than the general public. And I think you guys are overall good peeps. So thank you for putting up with me. Thank you for the all the support, especially from the new subscribers. And I hope everyone has a good one, and I hope everyone makes good profits out there. All right, I'll see you in the next one. Thank you.